Welcome to The Explainer. Today we are diving deep into the pretty complex world of shadow banking, and we're trying to answer a really crucial question. Are these institutions a major threat to our economy, or are they actually a vital part of it?
So this is the central mystery we're going to try to unravel. And our guide for this journey is a fascinating piece of research coming out of the Bank of England.
The paper itself is called, and it's a mouthful, Monetary Policy, State-Dependent Bank Capital Requirements, and the Role of Non-Bank Financial Intermediaries. It's by Manuel Gloria and Chiara Punzo.
Now that quote you see there, it's from the paper's abstract, and it just perfectly frames the core tension we're going to unpack. You see, it points to this fundamental trade-off that's right at the heart of modern finance. So how on earth did the researchers untangle this financial knot? Well, let's take a look at their approach. Okay, so to really get to the bottom of this, the researchers knew they couldn't just look at past data. The interactions here are way too intricate. So what did they do? They built a super detailed digital model of the economy. Think of it like a flight simulator, but for finance. This lets them run all kinds of experiments and see how the system reacts under different scenarios.
And this powerful tool they used is known as a DSGE model. Just think of it as a virtual economy in a box, a digital laboratory where they can poke and prod the financial system to see what makes it tick. I mean, it simulates everything, from your decision to save for a rainy day, to a company's choice to build a new factory, all the way to a bank's willingness to lend. And it's all interconnected in one massive, coherent simulation.
And here we see the two main characters in our little economic drama. You've got the established, regulated banks on one side, and the nimble, less regulated shadow banks, or NBFIs, on the other. And you can immediately see the trade-offs, right? Regulated banks, they have a safety net. They have to hold extra capital, their depositors are insured. NBFIs, though, they don't have those protections, but they also don't have the same heavy restrictions. They really have to rely on their own performance just to stay in the game.
Now, to make their simulation feel more true to life, the researchers added two really critical ingredients. First, they realized that bank regulations are kind of like a one-way street. Banks get into hot water for having too little capital, but there's no penalty for having too much. That simple observation completely changes how banks behave in the model. And second, and this is a key innovation, they directly connected the lending power of these NBFIs to the value of financial bonds. This makes them incredibly sensitive to market fluctuations. So let's see what happens when they hit the Run Simulation button.
So what happens when this virtual economy of theirs gets hit by, say, a monetary policy shock, like a sudden interest rate hike? Well, the first big reveal from the model is all about short-term danger.
Okay, so the first domino falls. The central bank decides to tighten policy, maybe to cool down the economy. This is a totally standard move to fight inflation, but in this particular model, it sets off a pretty unique chain reaction.
And boom, here's the first shockwave. When interest rates go up, the value of all the existing bonds out there drops. I mean, think about it. If new bonds are paying a higher interest rate, those older, lower-rate bonds suddenly look a lot less attractive, so their price has to fall. For NBFIs that are holding a ton of these bonds, this is an immediate, painful hit to their wealth.
And this drop in asset value, it's not just a number on a spreadsheet, it is a direct blow to the financial health of these NBFIs. Their net worth takes a nosedive. And since their ability to lend is directly tied to that net worth, well, the credit tap suddenly runs dry. And this happens at the exact moment when businesses and consumers might need that credit the most.
This whole mechanism is what the researchers call the asset price channel, and it is a crucial piece of this puzzle. You know, the conventional wisdom used to be that NBFIs could act like a spare tire for the economy when traditional banks got nervous. But this model, it shows the exact opposite. They can act like an accelerant, fanning the flames of a downturn and making a bad situation a whole lot worse.
And we're not talking about a tiny effect here. The model actually quantifies the impact. It shows that the very existence of this NBFI sector makes the worst-case recession scenarios, what economists call GDP at risk, a whopping 0.81 percentage points steeper. That is a huge amplification of risk. It basically turns what could have been a manageable downturn into a much more severe and painful recession.
But just when it seems like shadow banks are the clear villains of the story, the research reveals this really surprising twist when we zoom out and look at the long-term picture.
The paper finds that despite all those short-term risks we just talked about, having a larger share of lending come from NBFIs, it actually improves the overall health and welfare of the economy in the long run. So, what's the secret to this long-term benefit? Well, it all comes down to efficiency. As you can see here, because NBFIs aren't tied down by the same heavy and frankly expensive regulations that traditional banks are, they can be much more agile. This means more capital is actually being put to productive use in the economy instead of just being held in reserve to keep regulators happy. And that leads to greater overall economic growth in the long run.
So what's the final verdict? Are they good? Are they bad? This brings us to the core conclusion of the paper, and really the fundamental challenge for any regulator. There is just no easy answer here. What we're left with is a fundamental trade-off, and it's laid out perfectly right here. On one side, you have the short-term risks. We saw their pro-cyclical behavior. That's just a fancy way of saying they make bad times worse, not better. And that increases tail risk, which is economists speak for the chance of a rare but catastrophic event, like a deep financial crisis. But on the other side of the coin, you have those long-run benefits, a more efficient system and greater overall prosperity. This is the tightrope that every single financial regulator has to walk.
And this all brings us to the ultimate question that this research leaves us with. How do we get the best of both worlds? How can we possibly harness that long-term efficiency that NBFIs bring to the table without being exposed to the short-term storms they can kick up? Finding the answer to that question is one of the biggest challenges facing financial regulators today, and the future of our economic stability just might depend on it.